let's get started. So hello, everyone. Welcome back. And again, my name is Chris. I'm your co-host tonight. This panel event is brought to you by TCA-LA. I'm going to do a very short intro. For those who are not familiar with TCA, we're one of the largest and most active angel investment networks in the nation. We have invested over 450 companies with a total of investment exceeding 250 million. And our portfolio companies have attracted more than 2.1 billion in additional capital. With more than 450 members in TCA, we bring a diverse industry knowledge and critical business connections to our portfolio companies. Last year in 2021, TCA invested in about 60 deals and provided around 20 million in startup funding. And as part of our initiative to provide insights into opportunities available in, let's say, emerging industries, TCA have been hosting a series of panel discussions like this one, bringing together industry thought leaders, innovators, and capital providers to share their expertise. So tonight, we're fortunate and really have assembled a fantastic panel to discuss key trends in PE, private equity buyout. And to start things off, I'd like to go around and have our panelists introduce themselves. So in no particular order, first we have invited Amit Sinha from Microsoft. Amit, could you tell us about your background and your role at Microsoft a little bit?
Yeah, absolutely, and look, great to be here. So thank you, Chris, thank you, Matt, and everyone else for allowing me to be part of this panel. So I'm Amit Sinha. I'm the Chief Technology Officer for private equity here at Microsoft UK. It is slightly later here. I am actually sat in the UK, so doubly excited to be here for that reason. My role really is to work with private equity firms, the portfolio companies, and also with systems integrators, really helping them understand the business value of digital technology and really supporting them in that journey to digitization, to SaaSification, to Uberization, whatever you want to call it, and really ensure that they're getting the best value, the best business value, and the best business growth out of the technology that they start to adopt.
Great, welcome, Amit. Next, we are honored to have Sally Wong from KPMG. KPMG is one of our sponsors. Sally, could you tell us a bit about yourself and your team at KPMG?
Sure. Thank you for having me as part of this panel. My name is Sally Wong. I'm a director in KPMG's Deal Advisory Services, Deal Advisory and Strategy, actually. And, we're an audit, tax, and advisory firm. I've spent a little bit of time in audit. I have, for the last 12 or so years, spent my time more in the deal space. So I work with both corporates and private equity in buying, selling, and most recently, as you are all aware, I'm helping them through SPAC craze, getting IPO ready, whether it's through a traditional IPO or through a SPAC. So I'm very happy to be part of this panel.
Thank you, Sally. Next, we have Paul Lennick from ContinuServe. So Paul, tell us about ContinuServe and what are you working on right now?
Yeah, hey, thanks everybody. Good to connect here. So ContinuServe is a consulting firm that really helps in the back office for private equity portfolio companies. So we're typically coming in to reduce cost in the back office in finance, IT, and accounting areas. And we have a mixed model. We have onshore and offshore resources. So typically we're taking over the back office, if you will, for our VC funded and smaller portfolio companies that are private equity owned. And so we're doing the books basically for private equity portfolio companies, and we're managing the IT systems. And so we work with Amit on the Microsoft side. Sometimes we work with KPMG on the diligence side. And so we connect in across these M&A transactions, but ultimately our core competency is delivering back office services to portfolio companies.
Excellent, Paul. A pleasure to have you here. Finally, last but not the least, I'm sure you guys all know Matt. Matt from Skyview Capital. Matt is also a TCA-LA member. Hey, Matt.
Hi. Thanks, everyone, for coming to the panel. This is one of our Tuesday TED Talks, and I would pull this group together. And this was a little bit of a stretch for us in terms of the topic, but this is really the later stage of technology. TCA really focuses on these early stage businesses where we make investments, but eventually the ones that really do well, they grow up and they get bigger, they get revenues, they get cash flow, and then they make it interesting to private equity, or maybe they can talk to Sally about trying to do a SPAC IPO down the road. So we wanted to have this panel to talk a little bit more that, these, as companies scale and they sort of graduate from TCA, what the landscape looks like for them. And some TCA companies have gone on to do that. There's been several IPOs. There have been several companies that have been bought by private equity recently. So a number of our portfolio have gone into that area. Now, it typically takes a couple of years, more like 5 to 10 years to get to that phase, but we wanted to address that. So, Chris, did you want to talk about some of the upcoming events? I'm not sure if you hit up on that.
Sure, I was planning to save that toward the end, right? So the next event we have in April is about quantum computing. So definitely stay tuned. A very, very exciting topic. We got one of our panelists is will be from Google, in charge of quantum computing, VP of engineering. And there are other industry renowned speakers that will join. So definitely stay tuned.
Great. So I think we'll start with the Q&A portion, and then later on we'll open it up to the audience to ask questions. But I've got about 4 or 5 questions for the audience for the panelists first. So I actually do both early stage and later stage. I sort of can see the continuum of investing along the sort of private investment, alternative investment landscape. So for the group, what are some trends that you're seeing in private equity today? And why is it that it seems like there's more PE buyouts in technology, they're more common today than say 10, 15 years ago? So what are some trends that you're seeing in private equity today? Who'd like to start?
Yeah, I'm happy to start. Matt. So look, I think private equity probably have they have relatively well-defined buckets. Certainly from the interactions that I have, they have relatively well-defined buckets of problems that they've got across their portfolio, and it's actually quite nice because it really allows for the right it really allows for the right level of automation, if you like, across those programs. So one of them is cybersecurity. I don't know if you guys know this, but cybersecurity is something that really does apply to all SMBs, all enterprises across the entire estate.
Somehow you just went on mute.
Can you hear me now?
Yeah.
All right. Sorry. I don't. Did you heard about cybersecurity, right?
Yeah.
There's around 60%, give or take, of SMBs that are targeted by cybersecurity, by cyber attacks. So as they grow up through their life cycle, so that's absolutely key. Migration to the cloud is a second one. Data modernization and monetization is a third. That's kind of later stage. And then advanced technologies and differentiation. So AI, quantum, all that sort of good stuff. So there's really relatively well-defined buckets that these private equity firms typically look at for portfolio companies.
Sally,
maybe a slightly different angle there, just in terms of some of the trends. Private equity is like hot. There used to be just a small number of larger, well-funded, New York-based, Chicago, LA-based private equity firms that kind of dominated the space. Think of the 80s and 90s. But because of the economic value that can be accrued to private equity transactions, a lot of new entrants have come in. So, I've seen a lot of smaller firms emerge. Typically, it's 4 or 5 partners spin out of a larger private equity firm. They get their own funding. They take their money with them, or they take their fund sources with them, and then they start up. So there's been an expansion, I think, of the size and the number of private equity firms. And so thus the specialization of these firms is part of that. So you'll have, firms that are just focusing on family run, businesses that need to scale out, and they're in the $50 to $100 million range. You find other companies just in software businesses of a certain size. So there's been this proliferation, if you will, of size and industry domain of various private equity firms that have kind of come to life, in this recent day and age. And so that's kind of one trend that I've seen just structurally. The other thing that is interesting, maybe just in the last 2 years, is there's sort of a new breed of holding companies that are coming, into the market, where traditional PE model is you buy a business, could be a platform business, could be a bolt-on business, you try to improve it, you work with management, you replace management, you optimize the business, you exit in 3 to 5 years, whatever. But now holding companies are coming in the mix, where they're saying, hey, we're going to buy these businesses and not divest them. We're actually going to improve them, create an annuity for our investors, and it becomes another investment instrument, but it comes out of the private equity space. So I think there's a proliferation of size. There's also this holding company dimension that's occurring. And those are 2 kind of key trends that I see as I approach the private equity marketplace.
Yeah, I mean, I think that's well said. And I would just add on, so specifically to tech, right? Last year, I mean, PE investment, highest deal values we've seen, record breaking, right? Highest deal count. And of that, the highest is industrial manufacturing at about 32% of the deal in terms of deal count. But tech is right behind it in 25%. And I would say part of the reason is because I feel like the TMT sector is not even so much a sector anymore. It's almost become like a platform. It integrates everything. Like somebody bought me this mug and it's got tech in it. It's an Ember mug. It keeps your drink warm and it's so totally unnecessary and awesome, but everything has tech in it. And so I think some of it has to do with, how people label things. The other thing is, you hear a lot about ESG, and there's a lot coming down the line. The SEC just announced that, yes, they will require ESG reporting, and there's still a lot of uncertainty around what that reporting looks like. But I think once people are starting to put pen to paper and operationalize, okay, what are the KPIs that I need? What's the data that I need to be able to report? And how do I collect this information on top of everything that I currently have? You'll see a lot of emerging companies that are selling tech solutions for ESG. And it's interesting because everybody's kind of running toward this target that is moving at the moment. But I think you're seeing a lot of consolidation in the space. You will see a lot of consolidation in the space where every company across every industry is going to be required to do ESG reporting. How are they going to get the capabilities to do that? Are they going to farm that out? Are they going to acquire a company and develop their own capabilities and then sell it out? There's a lot of things that are directed by the current kind of social and economic environment here.
Yeah, that's great. We're actually, our next panel is after quantum is going to be ESG. So how does that relate to early stage investments? And our previous panel was cybersecurity. So these are all topics that we're investigating. Now, the one thing about private equity is, like, if you go back like 30 years ago, there were very few tech buyouts. Most private equity firms would buy stable manufacturing businesses that have steady cash flows. But what changed about 15 years ago is like Gores and Vista, they started doing tech buyouts because they saw that these subscription SaaS revenues are actually pretty reliable, and it's a pretty stable form of cash flow. And traditionally tech companies don't have a lot of physical assets, but you could actually collateralize those streams of subscription. So that's what really led to the growth of these tech buyout firms recently. And
yeah, hey Matt, just a comment on that. I think that's very intuitive. And what I've, like, if you take a step back and just think about TMT, and Sally's talking about TMT, telecom, media, but if you think about software, just the software component and these SaaS, these businesses that you're referring to, Matt, it used to be, say, 20 years ago that there was a consolidation, right? There was Microsoft, there was Oracle, there was these big, large, monolithic, software providers. And in order to get anything done, you as a company out there had to work with these larger, organizations that brought together all the pieces, whether they're financials, their human capital management, CRM, business intelligence. And so it was a portfolio of integrated solutions on a common platform that became a compelling business case to install those into your organization. I think in the last few years, the point solutions are reemerging as viable, right? You don't necessarily have to go to a Microsoft or an Oracle, forgive me, for everything in this day and age. And I think private equity has kind of realized that they can go purchase a smaller SaaS-based provider that has a point solution, in part because the integration schemas that exist now in open frameworks are much more plausible, and cost effective to deploy. And therefore you don't need an integrated platform out of the gate. You can rely upon middleware solutions to integrate your point solution, if that makes sense. And you can go ahead and purchase software that's more niche today and put together these solutions and do it in a cost-effective way and not have to sign up to a legally constraining or constrictive relationship with Oracle, for example. Not picking on Oracle, I love Oracle, but to be honest, they're pretty hard to deal with, at times. And so I think private equity, to bring it full circle, has realized that they can go buy a nascent or a smaller SaaS-based business and build that as a point solution and not try to build it into a Microsoft of the next era, but actually sell that point solution, allow on integration that's much more efficient now than it was even 5 years ago, and turn that asset into something more valuable through putting some dollars into it. So part of it, just talking about software piece, not the hardware, not the telecom, but just the software piece. There's a reverberation back to point solutions when 10 years ago, we thought we had to go with one of the big 3 or 4 enterprise providers in the marketplace.
I also think
I agree, Paul. And actually, all of that came about from the effectively from the adoption of digital technology back in sort of 2010, 11, 12, 13, right? You got the likes of Uber who really started to focus on the creation of this concept of a platform economy, where actually you're bringing folks onto a platform, you're becoming a platform player, and you're focusing far more on things like return of assets. And SaaSification came, SaaSification as a business model very much came from that. And actually, I think that's part of the reason why you're seeing the valuation of technology firms having risen so steadily over the last X number of years. But also, very honestly, because of the underlying infrastructure that sits there, you end up in a space where actually these technology companies can weather storms like COVID, like financial crises, and actually market dimensions, market transformations, market transitions, right? Because they have the ability to change and maneuver accordingly. So no, fully agree with you. Fully agree with you.
great. So I want to move on to like an area of focus for myself and for some other people on the panel. So Paul and Sally, can you talk a little about what corporate carve-outs are and sort of how they relate to buyouts?
Sure, I can start, and then Paul, feel free to add color. So I think corporate carve-out at its most basic is just the process of separating assets and liabilities, operating results for typically a line of business or a subsidiary or a division that companies want to divest of. And there's usually 3 reasons that I see. So the first is to divest of their non-core businesses. So it's a strategic move to focus on what their core business is. Second, sometimes it's just a cash flow issue, is to pay off debt or repurchase their own shares. And other times, and I think what we're seeing a lot more of that is actually they'll divest as part of an acquisition. And this has to do in large part now with the regulatory space. There's a lot of emphasis, especially now under the Biden administration as well, around fair trade and ensuring that you don't have these mega corporations that are effectively monopolizing the industry. And so, sometimes in order for corporates to get certain deals done and to acquire a certain aspect of a larger company, the regulatory reviewers, whether in the EU, whether here or even in China, they're going to require a sell-off of a portion of whatever they're acquiring, because they're obviously, okay, well, this is not a core part of your business, or it violates some kind of fair trade issue. And so, you know, I'm literally involved in a deal right now where my client is buying another a public entity, and the regulators are requiring them to sell off a portion of it, but the sell off of that portion of it is not in my client's core business. They've actually engaged a private equity firm to hold and divest, and there's just a very complicated like tax and buy sell investment structures, but a lot of the times it's looping in PE to be kind of your agent in the middle, so to speak, in order to get some of these larger deals done. So you see a lot of collaboration across both corporates and PEs. Oh, at least I've been seeing that in this space.
That's great. And then Paul, you started a carve-out consortium. What are your thoughts on carve-outs, and what do you guys do?
Yeah, I mean, carve-outs are kind of our specialty, and from an operational, you know, perspective. I think Sally did an amazing job articulating, you know, what carve-outs are from a realistic perspective. I think operationally, they're hairy, they're tough, they're challenging to get done, and we work on both the buy and the sell side. So there's carve-outs. The parent wants to divest this non-core business, as Sally articulated. That's maybe 10% of the time that we're engaged. Typically, it's the private equity side where we're on the buy side. We're trying to absorb NewCo, you know, if you will. And there's a reason why the parent is divesting that business. It's non-core, it's not running function properly, it's not profitable. Whatever reason, you're typically getting something that needs work. However, if you know how to work it, so to speak, there's tremendous value that can be creative. And thus, you know, the Platinums of the world and, you know, the Blackstones and the Apollos, they know this, and they are willing to go in and invest the time, energy, resources to take these carved out businesses, extract them from complex parents, and turn it into a diamond, you know, and make a ton of money on exit, you know, in that. And actually, it's not these tier one firms that are always doing it. It's the middle market firms that are doing it. It's happening, to my earlier comment, the smaller firms are realizing it's really hard to find a clean deal, right? If you're out there in private equity, it's extremely difficult to find an asset to buy. I mean, you're hunting, you're pecking, but if you can create one by approaching a parent that's maybe should sell something through an investment banker relationship, and you actually create a buy-side opportunity, and you turn it, you monetize that into some tremendous value, that's how these private equity firms are really approaching, you know, carve-outs. So it is hard to do. There's proliferation of it being done, and you have to be creative as an investment community to find them, actually create them, you know, if you will, you know, into the marketplace. But so my firm mostly focuses operationally, like how do you physically extract the IT systems, and how do you move the people and the benefits over, and how do you do the financial reporting and the FP&A over to NewCo, and how do you set up legal entities and bank accounts and all that machination stuff that, you know, the board of directors says, just go ahead and carve out that business and be done with it. But there's a year long of work under transition services agreements that are fairly complex and burdensome to execute against, that my firm comes in and we help private equity buyers typically execute operationally to extract that business called NewCo, get it renamed, get it cleaned up, if you will, get it standalone, and then typically build it as a platform business for further bolt-on. So, you know, I see a lot of proliferation of carve-outs. There's extreme value to be created in there. It's happening down market, not just up market, you know, in the future. But if you don't know what you're doing, and if you don't have a carve-out playbook, and to your question, Matt, around the carve-out consortium. So the carve-out consortium was formed by 14 service providers that focus on carve-outs. And so I brought this group together. It includes AWS, ADP, Lockton, Fortium, Globalization Partners, West Monroe, a bunch of firms that have private equity focused practices that do carve-outs. And so we call it the carve-out consortium. We work together behind the scenes to help private equity buy-side buyers extract businesses at deal speed, because all about time versus money, and do that in a cohesive way through IT, finance, HR, and related systems providers that are in this consortium, kind of banded together informally to execute these on behalf of private equity typical clients. So that's the consortium, Matt. And if you want to learn more about it, happy to share. There's press releases out there in the marketplace about it.
Yeah, and I think I would I was just going to say, I would be remiss if I didn't mention that, KPMG does a very similar work, and my turn to apologize to you, Paul. We do work with companies on the operational side as well, but we also support in kind of sell side diligence, buy side diligence, and then accounting advisory, which is my particular area of focus, but there's financial and accounting reporting requirements and impacts to everything. And like I mentioned, we're a tax firm as well. So we typically loop in our M&A tax folks to make sure that these deals are getting structured appropriately for the most beneficial tax results. So yeah, I just wanted to plug KPMG as well, which I'm sure you all know already.
And
Well, Sally, fear not. Like KPMG, you guys are doing Fortune 500. Like we are in the Fortune 2000. So we're stratifying the market a little bit differently there. We're working with smaller, VC funded, lower middle market, companies is where we cut our teeth. So no, there's no overlap there, no fear of offend. We are adding value in the marketplace, I think, in different segments of the market.
I think there's a lot of overlap and a lot of carve outs. There's so many things that need to be done. You have lots of advisors helping in a lot of different ways. And then KPMG is actually a TCA sponsor. So they were kind enough to introduce us to Sally to participate in this. So next question is, really for Ahmed and Paul, like, why are these technology firms like yours sort of starting to really work with PE clients? Like, what's the reason for that? Why are you having these PE practice groups?
Yeah, so absolutely. Paul, do you want to go first? Shall I?
I've been talking too much. You go, Ahmed.
No, absolutely. So look, I think the reason is twofold. Number one, there's a real opportunity on the table here. That you've got a number of technology firms, the likes of Uber, the likes of Netflix, you've got unicorns basically, and these unicorns have these unicorns really have changed the way in which the market looks at, or actually the way in which everyone looks at the market and looks at technology.
You want to cut in, Paul?
Yeah, I mean, we got a connection issue with the UK. I don't know, but yeah, absolutely to do that for sure. So I think, representing a service provider that has a PE practice, and having been at Apollo where, I got called on by all sorts of PE practices and various service providers, it's the force multiplier. Like, think about it. Let's say you're Microsoft, admit, right? And you want to penetrate a large private equity portfolio that has 100 portfolio companies or 40 portfolio companies. You basically have to sell once. You get into that private equity portfolio's playbook, you negotiate some sort of relationship that goes across their entire set of portfolio companies, and it's a force multiplier. And so that's the easiest way to scale your business. In fact, what I'm doing at Continue Serve, I'm calling on private equity operating partners every day and trying to get into their their playbooks. So when the phone rings, I know it's an opportunity, and I'm not trying to fight on each deal in the marketplace through an RFI or an RFP process to win work. I've literally developed a deep relationship of trust with the decision makers in private equity that are more interested in speed than they are on cost, typically, in my experience. And if I can have that relationship, it's a force multiplier for me. So when Francisco Partners calls, or Tom Bravo calls, or Apollo calls, it's sole source work. It's ready to go. I've proven myself within those organizations, and we're off to the races, and we're doing work. And so to me, that's the reason why economically the Salesforce and the SAP and the Microsofts and the Amazons of the world, all these tech companies have created internal PE sales and business development teams to go call on private equity, because that force multiplier.
Yeah, apologies, guys. I think I lost you at some point, but I'm not entirely sure how or why. Zoom just came down. Can you guys still hear me?
Yeah, we can. We just cut over to Paul in the meantime.
No, absolutely. This is why you should use Teams. I'm just kidding. No, so look, I was explaining that there's a number of technology firms that are out there, the Netflix, the Ubers, etc. These are all unicorns that are really that are really looking at, they've disrupted different markets, right? We've got to a point where of the S&P 500 companies, the average company age was about 90 years old back in 1935. In 2010, it was 14 years old. And actually, I believe in 2020, it's less than 12 years old now as the average age, right? For organizations, and I completely agree, I caught the last bit of what Paul was saying about force multipliers. The other aspects to this, alongside the fact that these organizations are potentially, are force multipliers and are effectively opportunities in this space. If you've got organizations that are only going to look at the stable recurring revenue that comes from enterprises, at some point, because of that age factor, those enterprises could fold. You could get an event like COVID that really, enables that or really pushes them down a particular direction. So diversifying for technology firms is obviously key. For consulting firms as well, I'm sure KPMG continues to have IMEX, Accenture. It's the same for us. I think that's absolutely another reason. The unicorns piece is particularly important though, and I think actually specifically for private equity, the beauty of private equity is that portfolio companies are going into or are being bought out by these private equity firms at the point where there is potential for business growth, and actually transforming these organizations so that they become enterprise ready and they have the right level of enterprise rigor in and amongst their technology, their infrastructure, their processes. That's absolutely another reason why that there's genuinely this opportunity for technology firms and for consulting firms as well.
I mean, an interesting statistic, I think Vista Equity, if you combine their portfolio of software companies, is like the third largest software company in the world. It's just amazing how you get that scale. So in terms of that force multiplier, you talk to one operating partner, you can talk to massive amounts of software businesses. So the next question I had was, and this is really maybe for Sally and maybe Amit, but could you describe like how or why a PE-backed portfolio company might buy like an angel-backed startup?
Yeah, I mean, I think typically you talk about portcos in either platform, like you can establish a platform company effectively. And so that is the strategy for a lot of these PE. So they'll identify target, they'll establish that target as their platform entity, and then they'll continue to tuck in smaller businesses. And I think I had heard earlier, there are specific solutions that smaller companies are providing. And Paul, to your point, they can create a lot of value by tucking that into that platform company to create a more holistic solution that maybe the sum of the parts is greater than the whole. And so I think that's typically what we're seeing. Yes, they are smaller deals, but I don't think that the size of the deal is necessarily proportional to the value that it brings in terms of synergies.
No, absolutely. And I just add to that, I mean, what Sally's just said about integration, that's absolutely key. I think decision points from, if I talk about it, the business side is absolutely how can you grow your offering? How can you look into areas that you're not potentially looking at today, and what organizations, regardless of size, certainly far more on value, what organizations make sense to fold into a portco. I think from a technology standpoint, there's actually a couple of key decisions. You really need to decide, certainly from an integration perspective, with the target organization that you're acquiring, what level of integration do you want? What level of compatibility are you expecting? There's the technology stack as well, and specifically, are you looking at folding these two companies together because there is an opportunity to elevate what you're doing or to optimize what you're doing? It can be a strategy. There is this concept of inorganic growth through buy and build. If you're going to be doing it multiple times, actually looking at potentially creating some form of integration platform to support you with that is absolutely going to be key as well. So fully agree with what Sally said. I think there's there's a number of technology decisions that need to be made alongside to support that growth and to support that business side.
Because I think for TCA portfolio companies, most likely the exit is going to be an acquisition. You know, it's relatively rare for a company to go straight from first angel check to an IPO, but being acquired is the most likely exit. And another question that Sally, you hinted on a little bit, but I'd love to get some more color. Like, can you talk a little about what you're seeing in the SPAC market these days? We've talked about SPACs a little bit. None of our portfolio have gone public via SPAC, but can you talk a little about what you're seeing there? There was sort of a rise and fall of the SPAC market over the past couple of years, but is it starting to come back?
So in 2021, that was like a record-breaking SPAC year, especially in the beginning. So the tail end of 2020 going into 2021, I mean, that was just ridiculous. And I think the SEC tried to put the brakes on it by putting a lot of rules and looking at very, I wouldn't say nitpicky, because I do think there's a basis for it, but things that they maybe wouldn't have focused on so much before, trying to do anything to slow down, because they were just from a capacity perspective, the SEC was overwhelmed. They were telling us, as an example, they have like a two-week maximum turnaround for certain comments. It's like, and they had straight up told our clients, like, don't expect anything any sooner than 2 weeks. We're just so behind. But in terms of companies seeking SPAC, I think it started to get this reputation as it was gaining steam that SPAC was an easy way to go public. And it is fast. It is true that it's fast, because you're basically tapping into a SPAC's existing pool of investors, and you're using their public and listed status in order to go public yourself, to access capital. And I think what we were seeing and how we were helping a lot of these companies is, I don't think companies were realizing how much work, how different it would be to need to be a public company, and that roadmap, the preparation from where you are now to get to being an SEC filing company was dramatically condensed. So typically, like an IPO readiness roadmap, we would put something in front of people and that would say, okay, well, it's about a year, maybe even longer, 18 months, 2 years, depending on where you're currently at now. And there's, certain priorities you got to hit. And, maybe at some point upgrade your ERP from QuickBooks to at least NetSuite, things like that. Now with SPACs, it's like, well, we've entered into a letter of intent. We now have, 4 months to get this thing closed. Oh, by the way, we're not ready. We're just now getting our first audit from a Big Four. Help us get there. And so there was just a lot of scramble with respect to SPACs, and a lot of these deals were coming out to be a little bit complex, because you have a lot of PE sponsors involved. And so we were getting calls alternatively on the other side saying, okay, well, if I'm a sponsor, how do I account for this SPAC? Like, what happens? Like, what do we do after our SPAC closes this deal? So anyway, that's just a lot. It's basically condensing a lot of your IPO readiness timeline. And I would say it's slowed down quite a bit. I think, at one time I had 4 live SPAC deals that I was helping with. And I think today I have one where they filed a couple of days ago, actually. So, it's definitely tempered down a little bit. And I think people are thinking a little bit more now back to your traditional IPO, if that is their strategy. But I think, Amit, to your point, there's so many unicorns. I mean, there's decacorns. I just learned that there are dragons now. And these companies, they're at the behest of their investors, but I think that's how investors are going to monetize, right? Is through some kind of exit. And so when you're that size, it's difficult to get, it would be a merger of equals effectively if you were going to get acquired. I think exit is going to be your best opportunity through an IPO at that point.
Yeah, and there are a number of unicorns here in the UK that are certainly, there's rumours that they're looking at that sort of space as well. And I think, to be honest, I think that there's going to have to be a sensible set of ways for these organizations to do this, because we're seeing more and more of these unicorns, these soonicorns pop up, right? I think I was reading again, this is UK based. I apologize. I don't know the US stats, but in the UK, I think in 2010 there was 8 unicorns. In 2020 there was 81, and in 2021 there was 91, with a further 134 that were in the pipeline. So there's absolutely, I think, going to be, you're going to end up in a space where, again, there's probably 2 or 3 key routes that you take, and there will be a preference for 1 or 2.
So what's the dragon? Is like 100 billion?
I have to look up what that threshold is, but
But
it's a mythical creature, is for sure.
yeah, but I mean, a unicorn's supposed to not exist, and yet there's hundreds of them that are yet to go public. So there's some disconnect in the marketplace that we're seeing these days. But hopefully, some of our portfolio become at least unicorns.
Yeah, and you know, that's the interesting thing, that it's all based on a valuation, right? And your valuation effectively is based on a forecast. So what you're doing is the market is betting on a forecast. And that's why I think, you know, especially in SPACs, there's so much focus being put on, okay, what went into your forecast and how realistic is this? Because a lot of valuations are based on, well, right now you're a loss-making company and you expect to be profitable, and oh, by the way, quadruple your revenue in the next 3 years. And your valuation is based on that quadrupled revenue in the next 3 years. So the question is, well, how sustainable is that? And is that just a function of how hot the market is, like the real estate market, right? You know, everybody wants a piece of it, and therefore valuations are being blown up. You may change nothing as a company. Your strategy may stay exactly the same, and all of a sudden the market just responds differently. Now you're getting a lower valuation with, again, not having changed anything operationally. So it is a little bit of a phenomenon at the moment, and can be a little bit fickle to cater to when you're saying, okay, well, we're only going to look at the unicorns, or we think that once you hit a certain valuation, you know, it's time for exit, because that valuation number is squishy sometimes.
But I think something like 50% of all SPACs that de-SPACed are under the $10 share price. I mean, it's very weak performance.
Easily. Yeah. I mean, and the redemption levels are so high. It's, you know, we had a few clients where the redemption levels were in the 90%.
Oh my
And we
gosh.
were looking at the amount of cash that they came out of the deal with. We're like, there's got to be cheaper ways to raise capital than going through a SPAC. But yeah.
I mean, the interesting thing about SPAC is, in a normal IPO, you actually can't give projections, but with a SPAC, you can give forecasts, which is part of the reason a lot of these startups with zero revenue like them, because they can put some numbers on the board. But then the real trick is you need to find pipe investors. Like, you can be a SPAC and you can try to you can find a company, but you need the pipe, which is like a Fidelity or Capital Group, to like believe in your story.
Yep. Because that ultimately, a lot of the time, your pipe investment is the only amount of cash that gets left in the organization.
Yeah.
For sure.
So Sally, another question for you to start off with is, like, let's say you're a TCA-backed company, and now it's, you know, got like 10 million of revenue. When should they start thinking about getting audited? And when do you think, what should they do to prepare to get acquired?
So, you know, I can probably just speak to where we're getting approached to take on audits, and it's generally around Series B and C. I think I've seen it more recently. The trend has been earlier, and I think, again, it's in anticipation of getting acquired by a company who potentially would go public. And so I think, you know, a lot of the times for us, because we're a Big Four, it can be cost prohibitive for smaller companies. So they'll, you know, engage a more local firm to do their AICPA audit. And then later on switch over to a Big Four when there's an actual need to do so. And that need to do so, I think a lot of the time is driven by, it depends on who is looking to potentially acquire you. If you're being acquired by an already public company, or you're being acquired by a company who is about to go public, and you're going to need to include your audited financials in their public in their public 10K or 8K as an exhibit, a lot of the times the banks or even these PE firms are going to request a Big Four audit, or even if they don't request a Big Four audit, the auditor of the acquirer is going to have to go in and reperform some of the work under PCA-LA, which is public company standards, as opposed to like a less stringent AICPA standard. So the need for an audit really comes down to your investors. And a lot of the times there's just banks require them. So if you have debt from banks, it'll just be a quarterly reporting requirement. I wouldn't say that necessarily revenue is a driver. We have a lot of pre-revenue companies asking for audits. That's largely in the life sciences space, but anything that's like research and development heavy. And in terms of, getting ready for the audit, I think
or more ready to be acquired. Like any tips for, because if you do M&A, like what are some of the things you want to avoid if someone's trying to buy you to make sure the deal goes through?
Yeah, keep clean books and records or good books and records. And, a lot of the times I feel like corp dev and strategy tends to run really hot, which is great. They are driving the strategy of the company, and they forget the rest of the company has to hold up the skirt and run after them. And so a lot of the times, and I'm obviously biased because I deal so much with finance, accounting, and tax, that everything has a finance, accounting, and tax impact, but nobody's talking to them early on. And so legal will enter into these deals. Corp dev will get very creative with these deals. And eventually when it's getting reported, they're getting a negative reporting impact because they never talk to accounting. They never brought in the rest of the organization, and I think that breakdown in communications causes a lot of surprises in the diligence process and a lot of surprises in the audit process as well, where you have to reverse maybe some of the revenue that you might have booked because that you shouldn't have booked it that way. And when your EBITDA when your valuation is based on a multiple of EBITDA, that top line revenue number really matters. So you want to get it right in the beginning. Don't forget about the rest of your organization while you're looking ahead to your vision and strategy.
What are you seeing in sort of this M&A landscape, Amit?
In what respect, Matt? I mean, there's a couple of different angles to this. I think I mentioned earlier the whole buy and build piece, and the need for, I guess, the need for a platform to support faster integration at different levels. I think that's one angle of the industry. I think the other angle is very honestly just very difficult, very hairy, very gnarly technology integration issues, where actually two organizations who are both on relatively complex, relatively legacy technology are trying to integrate because actually the business model makes sense, but the underlying infrastructure doesn't. So very honestly, I'm seeing it across a spectrum, if I'm being very honest. That's sort of how I'm seeing it. But did you have a specific angle when you were thinking about the question?
I just feel like, in your role at Microsoft, I mean, you're advising these PE firms. What kind of sort of technology challenges are they seeing in M&A?
Yeah, again, I think the biggest challenges, part of it comes down to strategy and really not. Oh, sorry, you guys have all frozen. I don't know if you can still hear me or not. All right, okay, perfect. Sorry. Properly having tech challenges today. The strategy piece is absolutely key, and often a lot of folks are not necessarily thinking about the strategy from an integration standpoint. They're thinking about it from a business standpoint, if that makes sense. So we've got two products actually. As an example, one works in one market, one works in another, but you could combine those together and you could actually disrupt both sets, right? They're not thinking about the actual integration of those platforms or those products. I think that's part one. I think the other aspect is potentially as you start to bolt these on, you start to build out that technical debt. and that technical debt becomes quite a big problem as you potentially look to exit the investment, because as part of the diligence process and as part of what Sally, Paul, everyone else will be doing, that they'll be looking at that IT estate and realizing actually there's so many different problems here that the business could start to have some real operational challenges in the future.
That's a good point. Just, if you do a lot of M&A and you just keep on rolling companies together that have technical debt, you're just building it on each other and just burying it deeper and deeper. So, M&A is a great chance to clean up the situation, but most people don't take that opportunity. They just sort of connect the things together.
One thing, just to add to that, Matt, one thing I have seen, which is particularly interesting, is I have seen people kickstart a transformation process off the back of M&A for that exact reason. So it's a really, really valid point. And actually it's an approach I think more and more PE firms are starting to take with their portcos.
So if anyone has any questions, feel free to post them in the chat. But we've got some other. Chris, do you have any questions for the panelists?
Let's see if we have any question from the floor. I guess I want to kind of carve out some time. Unless, Matt, you have any other questions?
I think since we got a pretty good technology group, beyond M&A, just what are some sectors you think are very interesting in technology these days? What are some interesting areas that our members or angel investors should be keeping their eyes open for? Like what's...
Yeah, maybe I could take a cut at that, Matt.
Yeah,
so
please.
I'm trying to think about the audience a little bit here with respect to kind of what's top of mind. And we talked a lot about private equity and carve-outs and digital transformation and SPACs, and these things I think are very insightful. Again, but I'm trying to think about its growth and scaling, some of these, nascent businesses that are trying to find their footing. I'm assuming, Matt, I'm not too close to the group, but, I think finding business partners, that are willing to invest, with you as a business, as you grow and have aspirations to continue to grow, I think is important. And, you've got amazing players on this panel discussion today, and working with those that are sort of scale to fit for your business from an industry perspective or size perspective. They're going to bring, partnerships that allow you really to focus in on your core competencies, what you're trying to develop, which typically is front office, for organizations, is important. So I just kind of implant that, within the construct of the discussion. I see a question coming across and around SaaS-based businesses. I think one trend we didn't talk much about, which is actually the hottest trend in software right now, and the fastest growth segment of software. Should I do like a question? Like, does anybody know what it is? Well, it's RPA, it's robotic process automation. And this area of software is really going to be transformational for businesses. Imagine using computer vision to record a process, on a computer, that a virtual robot can replicate that manual process and do it for pennies on the dollar relative to the manual labor that traditionally had done that. Imagine opening up an email, opening up an attachment, taking information out of that attachment in an organized structure, using that data to update a database, verify that that data is correct, publish a report with that, and do that like that 1,000 times. And so this robotic process automation is really growing. So UiPath, automation anywhere, key technologies that are really transforming this industry. And nobody knows much about it. Like everybody, robotics, robots, but it is happening. And we're working with quite a few clients really to do pilots, proof of concepts around this technology to sort of disintermediate the manual processes that sort of pull down the profitability of businesses. And the technology, I'll call it, is emerging. And it's just like going like that, right? So I view that as a real target area for private equity, and they are SaaS businesses. They fit into that category, but a segment within SaaS that's really going to create a lot of value for investors in the future.
Ahmed or Sally, any sectors that are exciting?
Yeah, so in terms of technology space, I completely agree with Paul. Actually, RPA, low code, no code solutions. I think that is certainly going to be a key wave, and it goes back to the point.
Thank you for letting me.
Sorry, that's going to be a specific space, I think, as organizations start to look to monetize their data, and there are a number that are. I think that's going to be a key space to enable the business to do that monetization, right? And to enable the business to start creating those reports, start creating those insights, and actually with the creation of AI models that are democratized in these no code platforms, you're going to get even more value from them. If I talk industry specifically for a couple of moments, I think travel is a particularly interesting one. With COVID, with everything that's happened with COVID, we're really starting to see a number of travel organizations come to us and start looking at AI solutions to try and optimize cost. I think that's one. I think healthcare is another. Healthcare with connected data, with the ability to really start to get insights into patients and into what patients can do to be preventative rather than reactive. So proactive rather than reactive. I think that's particularly important. And with the concept of this socially synergistic consumer, and we really need to find a better term for it. But with the concept of a consumer that now cares far more about health, given COVID, I think that's an interesting area. And then I very honestly, I think cybersecurity is another one. With everything that's going on today around the world, and with I guess with what could happen in the future with the likes of quantum, and I know Chris, you mentioned that quantum is going to be the next session for our audience. With things like quantum coming in and actually breaking or really shifting a number of paradigms in the computer science space, you're really going to start to see cyber, I think, boom, and it really is something that people probably haven't paid as much attention to as they should be paying attention to now. So I think cyber is going to be the other space across industries that it's going to be particularly interesting to watch.
I'd like to echo on what Amit was saying, right? So this is actually a very relevant topic, as I worked the last 5 years as engineering exec at a travel tech company. So definitely I see a lot of opportunities, and when Paul mentioned about automation and robotic, but that's definitely one of the key areas my last company and the current company are looking into, right? So I guess, Matt, we could maybe take another question. And there's one that's coming from Stuart related to Gavin, related to HR, and then I would say comments on people issues, right? So
yeah, I think Sally actually had to drop. She had a hard stop, but the question is really, do you have any sort of thoughts on acquisitions, integration, and the people issues? And I know Paul deals with this pretty regularly. I don't know, Amit, if you're seeing this as well when you're advising PE firms, but what are some of the people issues you're seeing in these acquisitions? And it's not just bits and bytes.
Yeah, I'll say it in one word: it's retention. You know, we are in a very labor challenged marketplace, and we put people in disruptive situations. They run for the exits unless you create an economic reason or strategic reason why they want to participate in a transaction. Call it a divestiture, an integration, whatever it is. You know, people will fly to stability and safety, and unless you think about the people issues as an investor in a business or a seller of a business, you're going to reduce the value of that transaction in one way or another. And I've seen it happen numerous times. You really need to engage a thoughtful process of tiering those employees that are impacted, and take that top tier aside and tell them what they need to know about their retention bonuses or their compensation or the longevity of their role. If you keep people in ambiguity too long, they'll leave. And in this marketplace, it's more pronounced because of the labor shortages and people checking out of the labor market. So people actually is probably the most value intrusive component of some of these transactions we're talking about. Technology happens to be one of the hardest things to do, but people is one of the things you'll feel the pain really quickly. So great question, Gavin, on that.
Yeah, I agree. I think the only thing to add is, again, it's something that really needs to be part of the strategy as you're looking at the potential integration of or the potential acquisition of these organizations. Certainly from the conversations I'm having, I'm seeing the back end of this. So at the point where actually attrition has got so high that you've lost the key folks that really help you make the product or make the platform or make whatever it is you're trying to create. You're desperately trying to get in this new talent that frankly at the moment does not exist, and it doesn't exist because we just don't have enough people that are trained in it. So I'm working with these organizations to actually create engineering teams from the ground up, but it is very much from the ground up, where they're having to learn the technology and learn and effectively learn the business system all at the same time. It's very, very, very difficult. So thinking about it at the strategy stage is absolutely key.
Yeah, and I think when it relates to TCA, like if we're growing some startup and it's 100 people and there's, the original founder, it becomes an issue, because if that person leaves, then the acquirer may lose interest. Or let's say it's only 5 people that we incubated, and now it's 5 people and they lose the 2 co-founders. That's a huge risk. So as we help grow these businesses, we want to consider how do they build out some redundancy and make it more stable of an organization. One question here from Stuart was, our PE acquisitions mostly of SaaS companies, and I think traditionally PE companies were looking at more like food manufacturers or industrial companies that had a lot of physical assets. And then over time, they shifted more towards technology broadly. So maybe hardware. But now the really high interest area is SaaS companies. So SaaS software, because of the recurring nature, the high multiples. There's a lot of operating leverage. So if you can put a couple SaaS business together, run it with the same management team, but you have a couple product lines, there's a lot of operating leverage that can lead to very high valuation. So I think that's why there's a lot of interest in SaaS right now, because if you buy a traditional manufacturer, those EBITDA multiples are pretty low, maybe like 8 times EBITDA and 1 times revenue, versus if you're trading in SaaS companies, they're like 4 times revenue or 5 times revenue. So just there's a lot more multiple expansion capability if you're looking at software companies than
Yeah, I think Matt Stewart asked a follow-on question. I think yes, it is SaaS, but there's this idea of taking a non-SaaS software business and converting it to SaaS. So that is where you can create value by picking up a traditional business that has some client server technology or some solution that has firmware installed in it and it's not in the cloud, and you call cloud optimization, working with Azure and Emit and team, and you refactor that solution to become SaaS, and all of a sudden your value explodes to the multiples that Matt's talking about. So the challenge is Thoma Bravo, Francisco Partners, everybody's hunting for these pure SaaS plays. And to my earlier comments, you got to create opportunities, either carving something out or converting a non-SaaS to SaaS, but that's where you get the multiple valuations. But I think that's kind of what's happening in reality. Stuart, hopefully that answers your question.
Yeah, I think one challenge is it's actually really hard to go from a traditional license model with maintenance for software and then switch it to a SaaS model, because the salespeople are very different, the compensation structure are very different, and you change the revenue dynamic. So in the short term, you take a big revenue hit, but then it spreads it out over time. But in the short term, it's very hard to make that conversion. So I think we've got one more question. This is more of a macro market question. I'm not sure what Paul and Amit's opinions on this are, but I'm curious to see. Just right now, markets have. I think Nasdaq's technically in a bear market. Do you think we're in for a bigger pullback, or you think things are starting to turn around and improve?
Whew, that's a very, very deep question. I'll talk about it from the pandemic perspective. I think there are world events right now that very honestly will change whatever happens, and that's going on I think a day-by-day basis with everything that's going on. I think certainly from a UK perspective, we're really starting to see the exit of the pandemic now. We've seen we've seen a relaxing of the rules. We've seen an expectation that folks can start to go back to the office. There's obviously this concept of hybrid work that is absolutely going to stay. But fundamentally, I think we're coming out the other end of it now, and we're certainly starting to see recovery activity going on. We've got our treasury that are looking very actively at that as well. I think specifically private equity, there is an expectation that private equity is going to play a major part in the recovery. And the reason for that from the private equity standpoint is actually there's a lot of opportunity there for them, right? A lot of these businesses have had to go through some form of SaaSification or transformation to really go on to the to really start to become part of the platform economy. And private equity are seeing those opportunities. They're seeing the EBITDA multiples, the revenue multiples, etc. And they're really trying to go after them. So certainly from what I'm seeing from a pandemic perspective specifically, we're starting to see the exit. We're probably not entirely there yet, and that's because actually, the entire world has to get to the point where they've opened up and actually where they're relaxing the rules. But certainly in the UK at the moment, that's the state of play.
Yeah, I mean, I'm not an expert. I think the questions are on valuations. I don't look at the statistics. Sally probably has that from KPMG in terms of the multiples and number of transactions. It's readily available from PwC as well, and other, firms that kind of monitor the space. I'd say, from our business perspective, we saw a tremendous demand the second half of last year, and it kind of dipped a little bit, after the holidays. I think people are just completely exhausted in the banking and the private equity and the transaction world. But now it's just coming back to where it was, in November of last year. So, anecdotally, I don't think valuations are going down. My guess is intuitively, if you look at dry powder, it's up. There's more powder seeking, fewer opportunities. So, supply and demand, no data behind it. I don't think so.
I do think that we got some overhangs of war in Ukraine, inflation, higher interest rates, and a tightening of monetary policy. I think is going to put an overhang on valuations in the public market. So you have to be more of a picker of stocks these days. But thanks so much for our panelists. I learned a lot. I think this is a different angle than we typically have, but showing a little bit later stage companies, which is really good. And looking forward to our future panels. And Paul and Amit and Sally, thank you so much for joining.
No, thank you. And apologies for the technical issues.
No worries. It's a Zoom issue. And thanks for everyone for attending.
Yeah, and this concludes our panel event for today. Thanks everyone.
Cheers, everyone. Bye-bye.
Bye-bye.